Holdings now with us. And Manish, it's just such an opportune time to have you because you would have thoughts on various things, right? The DeepSeek developments and what it means for business moats or the lack of them, if you will, even in the most storied sectors, the RBI announcements and maybe to a lot of people a little too late, but is it a shot in the arm that is required? And just the meltdown that the market seems to be in at a point of time when everybody thought that the Indian retail investor will make sure that no matter what happens, our markets will not sink. Where do we start from?
Well, morning, Neeraj. You're back from Davos, so you tell me what all the gurus in the world have said to you.
Yeah, well, I think a lot of conversations around DeepSeek got missed, if you will, out there because Trump was the towering figure out there, and I'm sure our conversation will invoke Trump as well, Manish. But maybe let's just start off with DeepSeek, Manish, because I'm sure you have a perspective there. We were speaking to CP Gurnani earlier. We were speaking to a founder of a AI firm earlier, and it does seem that this whole scarcity that was being built around capabilities that select companies would have, and it will be a domain of a very few. DeepSeek has challenged that, and it is showing in the way NVIDIA and some of the others are collapsing.
Right. No, it's fantastic that this is really disruption at its best. And my son explained it to me very simply. He said, you take algorithms, you take data, and you take computational power, and that's what gives you the outcome. So data is, of course, agnostic. And the route NVIDIA was going was by putting more and more compute power, the way Bitcoin has to be mined with more and more compute power. But the beauty of and the elegance of DeepSeek has been that the algorithm is better and more open source and powerful, a bit like what Google had put out with Android. So instead of pushing more and more compute power and thereby needing more and more power requirements, you've actually democratized AI. So it looks like a game changer for sure. So the fact is AI is like the next big thing for sure, and it might do to white collar people what the advent of machinery did to the blue collar workers. So over the next 5 years, the world will change substantially. And how we cope with it in India, because we are IT services sector and GCCs. In the short run, we'll make a lot of money off it, but in the long run, this is a cause of concern for us as well.
Manish, hi, Tamanna here, and so glad to speak to you today when there is so much up in the air. People are trying to make sense of everything. Suddenly you have these very young entrepreneurs coming up with these ideas, shakes everything up, and the impact from an Indian perspective as well. So let me start with that. A couple of factors here. First of all, if there is a global AI arms race, and that's what we are seeing, frankly, where does India stand with these new innovations? And for then listed companies, is there any impact at all? I mean, we're seeing one example. I was talking about an Anant Raj before we started this conversation. Is the equity space cut off from everything we've been seeing in the last 24 hours?
Tamanna, great question. So India honestly has largely been a bystander in this global arms race, which is happening between US and China. And for many, many years, we've existed by being, as you call it, order takers from the West. We would manufacture products for them or we would code software for them. And we haven't really owned our IP or our brands or our products. So this kind of developments of the last few years is obviously a wake-up call for all of us in the corporate sector. And the government's been trying its best through its PLI schemes and the kind of stuff they're trying to put out even to get people to focus on AI and start and build that out. But having said that, we are really a tier 2 player in what this is. What though does remain protected in India, and the best way I've always found in downturns in the market is to think of a company that I can buy, which is 5 years out, it's a 5 PE multiple, which means I need to have a view on what can happen to this company in 5 years and what could the earnings be in 5 years. And therefore, in this 5-year period, if it delivers, now whether the P ends up at 15 or 20 or 25, or like we saw in the last few years, it almost went heavenward, that's the best way to think about it. And wherever you can't reach a conclusion based on whatever you know, it's best to just avoid that sector. You don't have to make money in everything in this world. And if you're happy just being an index investor, then you have no business going and buying all these small, mid, disruptive companies, because you really don't know what the outcome is going to be in most of them. Let me pause on that for a minute.
Okay. Okay, since we brought up the subject of what is happening in the markets, and frankly, everyone watching this interview right now, Manish, will be wondering why have we not yet asked you about how you're looking at Indian equity right now. People are in a world of pain. India is dancing to its own tune, but not a very pretty one right now. When you were looking at Q3 numbers, corporate results, health of Indian companies and their balance sheets, what are you thinking?
All a function of valuation, right? Because I don't know if I was on your channel, but all the others which we did in Diwali, I think the whole focus of the discussion used to be on valuation, that you can buy the best company in the world, but if you've paid a wrong or a very fancy price for it, you're going to spend years and years recovering. And I'd given the example then using both Infosys of 2000, 2001, where it had hit a $45 billion market cap. And 24 years later, we are coming to a 90 or $95 billion market cap in dollar terms. In rupee terms, because the rupee has collapsed, it may look optically better. But in real terms, you didn't really make money because the price paid was too high. I'd also use the example of Zomato, which was the most popular company in which all of us have participated and done well. But to pay $30 billion for Zomato in 2004 was expecting a lot of the company to deliver by 2030. And sometime when the math doesn't add up, it's better to just sit on the sidelines and wait for some sanity to come back to the markets. And I think we're going through that. Whether DeepSeek had come or not, whether earnings had slowed down or not, we would have had some pause, given how overheated the market was and how priced for perfection we had become across sectors. Everything at 50, 60, 70 P multiple looked like so easy for most investors that there was reason for correction. And I'm glad in a way the supply response from both from the IPO, QIP market, promoters selling, overseas strategic investors selling has helped to cool things down. Nothing changes the structural trajectory of India. I still do think over the next 5, 10, 15, 20 years, this is a market which will create tremendous amount of wealth. But when you pay so much in advance for earnings, I think it's only right that we get a moment to pause and reflect.
Manish, that reflection, especially at the broader end of the spectrum, is now been very painful too. But I was looking at the valuations, right? The mid-cap 100 valuations relative to 3-year averages or 15-year averages look very different. Now, anything compared to 15 years averages, Manish, will look very expensive even now. My question is, where does, purely on the valuation argument, what do you think is the right valuation metric to pay for a market with the current growth dynamics? Is it 15-year averages? Is it the last 3-4 year averages, or is it somewhere in between?
See, reality is interest rate. The real interest rate is your force of gravity in the market. And in India, you've seen interest rates will typically tend to peak out at 8% on the 10-year, and it typically tends to bottom at a 5% on the same 10-year. And if you apply the reciprocal of that, if you do 100 divided by 5, the market tends to top out at a 20-time multiple. And the same reciprocal, if you do 100 divided by 8, we tend to bottom out at a 12.5 multiple. Now, if our view on interest rates is going to change for the world, which the West did by artificially suppressing interest rates and driving them very down, but fact of the matter is, if the US, 5-year and 10-year is closer to 5 rather than 2, which they had forced it down to, it makes a case for a reset of valuations downward globally, not just in India. And the India-US differential, because they still have the money printing power in the world, has to then get maintained, which is why RBI has been in a tight spot on both the rupee as well as on interest rates. So given this turmoil, I would err on the side of caution, because the only thing an investor has in his or her hands is the price we pay for entry. After that, everything changes. The macro changes, the company changes, the competitive dynamics change, the sentiments in the market can change. So only the price you pay is the true reality. And it has to be a price which is so compelling that the sector I may feel most bearish about, I should feel like buying. That really is the price signal that you ought to be waiting for if you want to buy something. So it won't happen to the entire market in one go. It's already happened in pockets. I still feel financials is very, very lucrative. If you look out 5 years from now, whatever happens to AI, whatever happens to technology, whatever happens to sectors and so on, Will some of these companies be around in 5 years? And do they look like 5 years out? These are 5P stocks. So that's just as an example of how to think about it.
No, but this is interesting simply because for the longest time in the last 12 to 18 months, while the blue chip banks and blue chip financials have looked inexpensive, people have not ventured to buy them because there are other things available. Suddenly now these look like pockets of hiding, and as you said, 5P multiple 5 years out. But would I therefore, Manish, but I'm just a bit alarmed by the first part of your answer, which means that if the valuations have to be reset to the levels or closer to the levels also that you're talking about, it would mean that Manish Chokhani, for example, doesn't seem to be in a hurry to deploy cash that he may be having right now, except for very select few pockets, and that too only at the margin.
Yeah, I mean, I typically I'm not doing a lot of things every year. A lot of the stocks I have are what I bought 4 years ago. I don't think I've bought a lot of things in the last year or two, because you spoke to anyone, they were happy buying a 100p stock, because why can't it become 150? So in that kind of frenzied environment, you better not be deploying capital. You just wait to harvest what you had already invested, which in few places we've done. All of us have cash. We're all waiting for something mouth-watering which will occur. It's not yet occurred. The median stock in India of the top 500 is down 33%. But if it's 33% down from a starting base of 100p, it's still probably a 67p. So there may still be a lot of room to go. And especially in the mid and small caps, which I think not just me, but most professional investors were kind of foxed with what was going on with the amount of flows which were coming in. But it's like the true test of capitalism, that supply response has actually met the demand. And then conditions have occurred, whether through a growth slowdown or a disruption in the overseas market, or a geopolitical development in again emanating from the US, which is resetting expectations for everyone. So the market will reset. It will take a couple of months to reset itself. But like I said, the long-term trajectory for our country still remains up. And I remain alert to see what one can be shopping for over the next few months. But it's no hurry to deploy this week or this month. I do think there's room over here.
Are you having a "I told you so" or "I was right" moment, Manish?
No, Taman, no, it never has, because look, we never be on 100% cash, right? So even if, let's say I'm 15% cash, 85% is suffering anyway.
Yeah.
But because you're invested for the terminal value, we're not sellers at any price point. When a company fully matures or you get something better is when you do the switch. So it's just good. It's healthy for our market to have had this correction. Let me put it that way. I don't wish a loss on anybody in this world, and especially not on people in India who invested. But some sense of sanity is always good for your long-term health.
How close are we to that point of sanity in your view? What I'm trying to understand is that right now, when you're talking about mouth-watering opportunities, are you spotting any semblance of this, or we're some time away?
Yeah, no, it comes across sectors. Like I'm saying, 5P stock 5 years out. There are some which are 5P on 1 year out. So there are opportunities out there. But having said that, when you go to an excess on the upside, the downside also goes to an excess. So it's not like when we should have stopped at a 20 market P, we may have gone to 24. Same way, if the market P should probably bottom at 12.5, it maybe you bottom at 10. So we don't know. I mean, quite honestly, it has to be a price at which you're comfortable. And like I said, you invest for really terminal value. And if you don't want to hold something for 5 years, I always say that in a bull market, you're renting a stock. And in a bear market, they return to their rightful owners. So I'm looking at it as trying to be a rightful owner. If I don't want to own this company for the next 5 years or more, then I shouldn't be buying it today. And if I can't imagine what this company can be in 5 years, or I'm worried about disruption or competition, margins, whatever it may be, then I can just stay away from it. I don't have to swing at every ball that is thrown my way. So that's the way I would approach it.
In the current scenario, and we talked about correction which was due. You spoke about that this was return to sanity which was required, but the underlying question is about what's happening with the Indian economy. We're speaking with you, Manish, just ahead of the budget, and right. I'm wondering what you are going to be looking out for in the statements that come in. The expectation is that there is at least some hint at a push coming in from the government in very troubled times, even globally.
Yeah, look, the typical things that we want government to spend a lot more, especially on capital expenditure. We want them to maintain fiscal prudence. The markets are already, I think, pricing in a 4.5% deficit number. But remember, pre-COVID, we were at 3.5, and we were trying to trend lower from there. So a lot of the heavy lifting from the center has honestly been done. And even the corporate tax rate cuts, which had come earlier, did not really reignite capital expenditure. And it's something to pause and think that why is the Indian corporate sector not getting into IP creation, product creation, trying to own its technology, trying to go a lot more global? Is it ease of doing business? Is it there's too much compliances to happen? Is it they're worried about excess capacities in China? Is it they're worried about the K-shaped recovery in India? Are we worried about this jobless growth going on? So the budget is merely one document which is doing our accounting for a year, but there are some more policy impulses and stuff which needs to happen really at the state and the ground level for this ease of doing business, for the animal spirit in a sense to get reignited. And I'm hopeful to see some signs of that, which this government has done a series of fabulous things over the few years. We've got new leadership now, both in the finance ministry in terms of the secretaries, in the RBI. So there should be some level of fresh thinking. We've seen some of the ministers, like when you met in Davos, who are making some very positive moves on infrastructure and so on. So there's no reason to be despondent, but the market clearly needs some more reignition of animal spirits, particularly from the corporate sector, not the retail investor anymore, to kind of give us the next fillip of growth. And certainly on jobs, I think that's something people watch out a lot for.
Yeah. So I mean, unless the private sector probably seems to be pointing towards a point of view, Manish, seemingly that unless they see demand, why would the private sector put in capex to work? But we've seen some MOUs signed, etc., as you said, even in Davos too. Would you believe? I mean, and we were speaking to Thermax just before our conversation, and he was of the opinion that there are some signs of a recovery, marginal recovery, which still has to be established. In your conversations with corporates, etc., Manish, do you sense that private capex at the margin might be turning, or is it some time away?
No, see, capex has been happening, but it's been happening in the newer sectors, right?
Right.
So you'll put up a lot more data centers and stuff like that. You're not putting up new steel. Well, now even in Gadricholi and all, you are putting up new steel mills and so on. So it's not that it's not happening, but that burst of enthusiasm where the aggregate demand, I guess, capacity utilization probably is in the 75 or sub 80% across manufacturing. And what I'm alarmed with is our manufacturing share of GDP, which ought to have gone towards the target of 24, has actually gone down more towards 13 or 14%. And if you got to lift a billion people, get 10 million people jobs every year, it is going to happen only in manufacturing. You can't put them into high value services. I worry about, I mean, I don't want this to be a day of worries, but if you think of it, in the 90s, we were adding IT service sector jobs. In the 2020s, we are adding jobs for delivery boys for, I mean, not to disparage anyone, but the differential in the job has gone to 1/10 rather than going 10 times higher. So if you have to get per capita income up, it is not going to happen without manufacturing and being an exporter and a producer for the rest of the world. And we'll have to go and compete with the China producers of this world. Can't wish it away. And we will have to invest a lot more in technology and owning our own products, because the servicer or the processor is only going to make that 15% type return on capital, which the end buyer is always going to try and push you down.
Yeah.
So we have to own our own platforms, products, technology, brands. That's the only way out. That's the sort of companies to think about.
So Manish, here's my question: what would you have the budget, or let's say not just the budget, but the announcements post-budget layout as well? Because one is the long-term thinking that happens, but in the short term, in order to fill in the budgets, if the government is doing PLIs and various manufacturing incentives, and even if that is not able to lift the manufacturing share of GDP to the desired trend, if not the actual number, what else can be done?
You need a lot more manufacturing jobs to be created. So labor being rewarded, like you have a depreciation allowance, which comes and gets a set off to people. If you don't get that for employing people, for internship programs, for R&D investments, that is the only impulse you can give to companies. But if the companies themselves are sitting and scared that how do I compete with China, even with these incentives, then there's no way out. And look, the big business houses, whether it's the Tatas, Ambanis, Adanis, Jindals, they've all been doing their bit, right? So this has to get a little more broad-based. So if, say, a Jindal goes and says, I'm going to put up EV manufacturing and compete with China, and the market's kind of skeptical about it. The same thing will apply to, say, Tata goes and says, I'm going to go and put up semiconductors and become a Foxconn. It can't happen until they build that, and then only they can go up the value chain. So there are a few years where we'll have to digest this transition, and only then, make the next leap up. But it has to get broad-based, and it's a mindset. Like when someone says Swachh Bharat, you need to be clean, or Viksit Bharat, then you need to be developed. The same thing, it has to be India as a producer nation for the world has to become the center stage mantra for all of us. And reform now clearly needs to go to the state level. This looking at central union budget, I think now, your hands are tied 4.5% on this side. You have to do some freebies for the poorer sections. You have to do a lot more capex. You really don't have that much of fiscal elbow room to try and influence. It has to go to state level now. And that's going to be a lot more interesting how they play out. As you're seeing the Maharashtra CM, right? He's come back and he's put a new dose of energy into how Maharashtra wants to play its game.
Just, Mr. Chokhani, I think if I end this interview without asking you about what you make of Trump and the fears of a tariff war unleashing from the Indian context, I would be completely amiss. So, let's get that view in. I think more than the internal budget, India needs to be ready to respond to whatever comes our way.
Yeah. So look, I'm no expert in this, but I see this, that when you're playing with the big boys, and it's clearly a fight between US and China and the two autocratic guys, Trump's behavior is very similar to Putin. If Putin says, I want to go and take Crimea because I want access to the sea, and Trump says, instead of war, I'm going to go and buy out Greenland. I mean, this is bully behavior in the world. And that's how they're choosing to play the game. So in a world of autocratic leaders who have to fight amongst themselves to say, who's the boss, we will have to learn how to navigate this, because we are not trying to be boss for anybody. So the way we played it when the war happened and we managed to get cheap oil from Russia, or when the war is happening in the Middle East and we're navigating both the Arab as well as the Israeli side very well, I think that India is playing its cards pretty okay. And we don't need to try and overstate our position. Our growth will happen. It will happen inevitably. But we just have to be a lot more thoughtful and conscious about it.
Well, navigating in times of Trump, in times of a disruption, tech disruption, and then, of course, looking at where our markets go. Interesting times for this excellent conversation. Thank you so much, Mr. Chokhani, for speaking with us.